$38 trillion. That's how much the United States owes today. But here's what makes no sense. Every country on Earth is drowning in debt. If everyone owes money, who exactly is getting paid? In 1923, Germany was the industrial heart of Europe. Their currency was backed by gold, their military was legendary, and their economy dominated the continent. Within 18 months, their money became toilet paper. In 1989, Japan controlled 40% of the world's stock market value. Their real estate was worth more than the entire United States. Within 36 months, they entered a depression that lasted 30 years. In 2008, Greece had a stable economy, euro membership, and investment-grade credit ratings. Within 24 months, they needed 3 separate bailouts to avoid complete collapse. 3 times, 3 developed nations, 3 catastrophic collapses, all following the exact same 7-stage debt sequence. And here's what should terrify you. The United States has already completed 5 of those 7 stages. We're not approaching this pattern. We're deep inside it. And it's happening faster than the Federal Reserve wants to admit. This is the story of how empires die financially, why they always think they're different, and why the mathematical inevitability says we're next. This isn't conspiracy theory. This is documented economic history. The meetings happened. The bailout requests exist, and I'm going to show you exactly where America sits in this sequence. Let me start with something that will make you understand the scale of what we're facing. The United States pays $1 trillion per year just in interest on our debt, not paying down the principal, just interest. That's more than we spend on defense, education, and infrastructure combined. In 1980, interest payments were $52 billion. In 2024, they hit $1 trillion. That's a 1,900% increase, while GDP only grew 340%. But before I show you how this pattern destroys countries, you need to understand what the 7 stages look like. Because once you see them, you'll recognize them everywhere. Stage 1, excessive borrowing. During good times, the country experiences rapid growth, usually after a war victory or resource discovery. Leaders assume growth will continue forever and borrow against future prosperity. They use debt to fund expansion, infrastructure, and social programs. The economy appears unstoppable. Stage 2, interest rates. Kept artificially low. Central banks suppress interest rates to encourage more borrowing. They claim it's temporary stimulus, but it becomes permanent policy. Cheap money floods the system, creating asset bubbles in real estate and stocks. Debt to GDP ratios climb quietly while everyone focuses on rising asset prices. Stage 3, debt to GDP crosses the point of no return. This happens around 90% for developed nations. Beyond this threshold, every additional dollar of debt produces less than $1 of economic growth. The country is now borrowing just to service existing debt. Politicians deny there's a problem and promise the economy will grow out of it. Stage 4, interest payments become a major budget item. Interest costs start consuming 10 to 15% of government revenue. This crowds out spending on defense, education, and infrastructure. The government faces a choice: cut popular programs or borrow more. They always choose to borrow more. Stage 5, debt spiral becomes mathematically unstoppable. Interest payments exceed 20% of revenue. The government is borrowing money just to pay the interest on money they borrowed before. Every budget is a deficit budget. Even zero spending on everything except debt service wouldn't balance the books. Stage 6, currency crisis and emergency measures. International confidence collapses, credit ratings get downgraded. The currency loses value rapidly. The government implements capital controls, freezes bank accounts, or starts printing money to pay debts. Hyperinflation or severe deflation follows. Stage 7, economic collapse or default. The government either defaults on debt obligations or hyperinflates the currency into worthlessness. Social unrest erupts. The political system usually changes dramatically. The country becomes economically irrelevant for decades. Now, let me show you exactly how this played out in 3 different countries, with 3 different approaches, but identical results. Germany in 1918 thought they were different. After World War I, they faced massive reparation payments to the Allied powers. But German leaders weren't worried. They had the most advanced industrial economy in Europe, the best educated workforce, and centuries of engineering excellence. They believed German productivity would solve any financial problem. Stage 1 started during the war itself. Germany borrowed heavily to fund their military, assuming victory would let them extract wealth from conquered territories. When they lost, those war bonds became immediate obligations, with no captured resources to pay them. Stage 2 began in 1919. The Reichsbank kept interest rates near zero to stimulate recovery. They argued that low rates would encourage business investment and employment. Instead, it made borrowing irresistible for both government and private sector. Stage 3 hit by 1921. Germany's debt to GDP ratio exceeded 100%. Every mark borrowed now produced less than a mark in economic value. But Chancellor Heinrich Brüning insisted Germany would export their way out of debt. Sound familiar? Stage 4 arrived in early 1922. Interest payments consumed 23% of government revenue. Germany couldn't fund basic services without borrowing more money. They delayed reparation payments, triggering French occupation of the industrial Ruhr Valley. Stage 5 became obvious by mid-1922. Germany was borrowing money to pay the interest on previous borrowing. The debt spiral had become mathematically infinite. The exchange rate went from 320 marks per dollar to 7,400 marks per dollar in just 6 months. Stage 6 exploded in 1923. International confidence evaporated completely. The mark became worthless paper. Germans needed wheelbarrows full of currency to buy bread. A loaf of bread that cost 250 marks in January 1923 cost 200 billion marks in November 1923. Stage 7 completed by late 1923. Germany effectively defaulted through hyperinflation. Their currency became so worthless that people burned it for fuel because it was cheaper than firewood. The economic trauma paved the way for political extremism that changed world history. The entire sequence took just 5 years. From industrial powerhouse to economic wasteland, in less time than it takes to get a college degree. But you might be thinking, okay, that was post-war chaos. What about a modern, stable democracy? Let me tell you about Japan. Japan in 1985 was the economic miracle of the modern world. They had zero inflation, massive trade surpluses, and the highest savings rate on the planet. Their manufacturing quality was legendary. Their currency was strengthening against the dollar. Everyone predicted Japan would become the world's largest economy within a decade. Stage 1 began after the Plaza Accord of 1985. Japan agreed to strengthen the yen to help U.S. trade deficits. To compensate for the stronger currency hurting exports, Japan lowered interest rates and increased government spending. Debt-financed growth became national policy. Stage 2 accelerated through the late 1980s. The Bank of Japan kept rates at historic lows. Money flowed into real estate and stocks. Land prices in Tokyo became so inflated that the Imperial Palace grounds were worth more than all the real estate in California. The Nikkei stock index hit 38,915 in December 1989. Stage 3 struck by 1990. Japan's debt-to-GDP ratio, including private debt, exceeded 400%. This was the highest level any developed nation had ever reached. But Japanese leaders believed their superior saving culture and manufacturing excellence made them immune to debt problems. Stage 4 became undeniable by 1992. The stock market had fallen 60%. Real estate values collapsed 70%. Corporate bankruptcies multiplied. The government increased spending to stimulate the economy, pushing debt levels even higher. Stage 5 locked in during the mid-1990s. Japan entered a deflationary spiral where falling prices increased the real burden of debt. Every year, the same amount of yen bought less economic activity. Debt service consumed increasing shares of both government and corporate budgets. Stage 6 lasted for decades instead of months. Unlike Germany's hyperinflation, Japan chose slow-motion collapse. They kept interest rates at zero for 25 years. They ran massive budget deficits every single year. They tried 18 different stimulus packages. None worked. Stage 7 never technically arrived because Japan had massive domestic savings to fund their debt, but they paid the price in lost decades. From 1990 to 2020, Japan's economy grew at just 0.9% annually. An entire generation entered the workforce during economic stagnation. Birth rates collapsed. Social vitality disappeared. The lesson from Japan is that Stage 7 doesn't always mean hyperinflation or default. Sometimes it means 30 years of economic zombification where you're alive but not living. Now, let me show you what happens when a country tries to muddle through the crisis. Greece believed they had found a different path. Greece in 2000 had just joined the European Union. They were part of the euro currency system, which meant they couldn't devalue their way out of problems. But Greek leaders saw this as an advantage. Euro membership gave them access to German-level interest rates. They could borrow at 3% instead of the 15% they previously paid. Stage 1 began immediately after euro adoption. Greece borrowed massively to fund infrastructure, social programs, and government employment. The 2004 Olympics alone cost 15 billion euros. Debt to GDP went from 94% in 1999 to 127% by 2009. But euro membership meant European banks were eager to lend. Stage 2 was built into the system. European central bank policy kept interest rates low across all euro countries. Greece got German rates with Italian fiscal discipline. Politicians used cheap money to expand government employment, early retirement programs, and generous pensions. Stage 3 hit during the 2008 financial crisis. Greece's debt to GDP reached 146%, but the real problem was revealed. Greece had been using derivatives to hide the true extent of their borrowing. Goldman Sachs had helped them structure deals that kept debt off official books. Stage 4 exploded in 2010. Interest payments consumed 27% of government revenue. Rating agencies downgraded Greek debt to junk status. Borrowing costs spiked from 3% to over 25%. Greece faced immediate bankruptcy without external help. Stage 5 became a European crisis. Greece couldn't pay, but European banks held 200 billion euros in Greek debt. A Greek default would trigger bank failures across the continent, so Europe chose to bail out the banks by bailing out Greece with harsh conditions attached. Stage 6 lasted from 2010 to 2018. Greece received 289 billion euros in bailout funds. In exchange, they implemented austerity measures that shrank their economy by 25%. Unemployment hit 27%. Youth unemployment reached 58%. Social unrest included riots and the rise of extremist political parties. Stage 7 was avoided through external intervention, but at enormous cost. Greece lost economic sovereignty for 8 years. European institutions controlled their budget, tax policy, and government spending. The economy shrank to 75% of its 2007 size. A generation of young Greeks emigrated to find work. Greece survived by surrendering independence. They avoided collapse by accepting colonial status within Europe. 3 countries, 3 different approaches. But notice the pattern. The stages always happen in the same order, and the mathematics always wins. Now here's where you should start paying very close attention, because I'm going to show you that the United States has completed 5 of these 7 stages, and unlike Germany, Japan, or Greece, America doesn't have a larger economy to bail them out. Stage 1, excessive borrowing. During good times, check. This began after World War II victory, accelerated during the Cold War military buildup, and became systematic after 1971 when Nixon removed dollar-gold convertibility. America borrowed against future prosperity during every expansion since 1980. Stage 2, interest rates. Kept artificially low. Check. The Federal Reserve has kept rates below historical averages for 25 of the last 30 years. The 2008 crisis made zero rates normal. Even today, with inflation concerns, rates remain below the long-term average of 6%. Stage 3, debt to GDP crosses the point of no return. Check. U.S. debt to GDP hit 100% in 2012 and now stands at 125%. This exceeds the 90% threshold that historically triggers diminishing returns on additional debt. Every dollar borrowed now produces less than $1 in economic growth. Stage 4, interest payments become a major budget item. Check. Interest payments reached $1 trillion in 2024, consuming 17% of federal revenue. This will rise to 23% by 2030, according to Congressional Budget Office projections. Interest is now the second largest federal expense after Social Security. Stage 5, debt spiral becomes mathematically unstoppable. Check. The U.S. ran a $1.8 trillion deficit in 2024 despite strong economic growth. Even if we eliminated all discretionary spending, defense, education, infrastructure, everything, we would still run a deficit due to mandatory spending and interest payments. That's 5 of 7 stages completed. The United States is deeper into this pattern than Germany was in 1922, than Japan was in 1995, or than Greece was in 2009. But here's what makes America's situation more dangerous. We're the global reserve currency. When Germany collapsed, they could devalue against other currencies. When Japan stagnated, they could export to growing markets. When Greece failed, Europe could intervene. But when America reaches stages 6 and 7, there is no external savior. The dollar is the global financial system. Let me show you why stages 6 and 7 are now mathematically inevitable unless something dramatic changes. The Congressional Budget Office projects U.S. debt will reach 181% of GDP by 2053, but that assumes average interest rates of 4.1%. If rates return to their historical average of 6%, debt reaches 200% of GDP by 2045. If rates hit 8% during a crisis, debt becomes infinite within a decade. Here's the really terrifying math. At current debt levels, every 1% increase in interest rates adds $380 billion to annual interest payments. That's larger than the entire defense budget. A return to 1980s interest rates would make interest payments larger than all other government spending combined. Stage 6 begins when foreign creditors lose confidence in dollar-denominated debt. This could trigger from geopolitical conflict, domestic political instability, or simply mathematical recognition that the debt can never be repaid. Foreign ownership of U.S. debt has already fallen from 50% in 2008 to 30% today. China and Japan, the largest foreign holders, have been reducing their positions. When foreign buying stops, the Federal Reserve faces an impossible choice. Let interest rates spike to attract buyers, or print money to buy the debt themselves. Spiking rates would trigger immediate recession and make the debt spiral worse. Money printing would trigger currency crisis and inflation. Stage 7 becomes inevitable because mathematics doesn't care about American exceptionalism. The dollar might remain the global reserve currency, but that doesn't exempt America from the laws of compound interest. Reserve currency status might actually make the collapse more severe by creating global financial chaos when it happens. Here's what stages 6 and 7 would look like for America. Stage 6 starts with a currency crisis triggered by foreign creditor withdrawal. The dollar loses 30 to 50% of its value against other major currencies. Import prices spike, triggering inflation above 15%. The Federal Reserve faces demands to raise rates to defend the currency, but higher rates make the debt spiral worse. Social unrest begins as inflation destroys middle-class savings while debt payments consume increasing portions of government revenue. Infrastructure spending stops, social programs get cut, military spending gets reduced, political extremism rises as economic hardship intensifies. Stage 7 arrives when the government faces default or hyperinflation as the only choices. Default would mean Social Security stops, government employees don't get paid, and military contractors don't get paid. Hyperinflation means the dollar becomes worthless paper, destroying savings and fixed incomes. Either path leads to economic collapse, social breakdown, and political revolution. The American empire ends not through military defeat, but through mathematical inevitability. But here's what you need to understand. This isn't guaranteed to happen next year or even next decade. Japan has been in slow-motion collapse for 30 years. The question isn't whether this pattern will complete, but how fast it happens and what triggers the final stages. The triggers could be geopolitical, war with China, collapse of NATO, or loss of petrodollar agreements. They could be domestic, constitutional crisis, social unrest, or federal government dysfunction. They could be economic, banking crisis, corporate debt defaults, or state government bankruptcies. What matters is recognizing that America is already past the point where this can be solved through normal political processes. The debt spiral is mathematically unstoppable, without dramatic action that no politician will take, because it would require immediate economic pain to prevent future collapse. This is why the pattern has repeated throughout history. Politicians always choose to kick the problem to the next administration rather than implement painful but necessary solutions. By the time the crisis becomes undeniable, it's too late for gradual fixes. The United States is now at the same point where Germany was in 1922, Japan was in 1995, and Greece was in 2009. We're in stage 5 of a 7-stage process that has never been stopped once it reaches this point. The only question remaining is whether America will collapse through hyperinflation like Germany, economic zombification like Japan, or surrender sovereignty like Greece. But some form of stage 7 is now mathematically inevitable, unless the laws of arithmetic stop applying to American debt. History doesn't repeat, but it rhymes. And right now it's rhyming with the collapse of every over-leveraged empire in recorded history. The difference is that when America collapses, it takes the global financial system with it. That's not opinion, that's mathematics. And mathematics always wins.